Beyond Meat once had a 4x revenue multiple and a 14 billion valuation. Beyond Meat was founded in 2009. It was born out of concerns over animal welfare, human health, and climate change. The goal was to create a plant-based alternative to meat that could change the world. To build this vision, the company sought significant outside capital. It raised $72 million in financing from a diverse group of investors. This included the venture capital firm Kleiner Perkins, the billionaire Bill Gates, and an unlikely partner Tyson Foods, a traditional meat company. These early investments provided the runway for the company to scale its technology and distribution. By the time it reached the public markets, the appetite for the product was immense. The company wasn't just selling a burger, it was selling a narrative of sustainability and innovation. This early momentum set the stage for a market debut that would eventually see the company valued at roughly $14 billion. The company's transition to the public market was a blockbuster event. In May 2019, Beyond Meat launched its IPO, and the reaction from investors was immediate. Shares jumped 65% in the first year alone, eventually surging to a peak of $239.71 in July 2019. This euphoria was fueled by a sense that the company was disrupting an entire industry. The momentum was bolstered by high-profile partnerships. As restaurants like McDonald's added Fox meat burgers to their menus, this craze didn't just benefit Beyond Meat, it created a ripple effect across the sector, sparking investor appetite for other alternatives like cow-free milk. But beneath the excitement was a startling valuation. The business IPO'd at a 4x revenue multiple. A revenue multiple is a valuation metric that compares a company's market value to its total sales. For context, most consumer packaged goods, or CPG, businesses, which are companies that sell physical products through retail channels, typically trade on a thanks to 2x revenue multiple. By pricing the company at 40x, the market wasn't valuing Beyond Meat as a food manufacturer, it was valuing it as a hyper-growth technology company. In 2019, the optimism was backed by projections. Data from Barclays forecast that the global foxed meat market would generate $140 billion in annual sales over the following decade. At the time, it seemed as though the company was simply growing into its massive price tag. To understand why the market viewed Beyond Meat as a tech company, you have to look at the revenue multiple. A revenue multiple, or price-to-sales ratio, compares a company's total value to its annual sales. It is a shorthand for how much investors are willing to pay for every dollar of product the company sells. In 2019, Beyond Meat IPO'd at a 40x revenue multiple. To put that in perspective, most CPG, consumer packaged goods, businesses, which are companies that make everyday products like snacks and soap, trade on a thanks to 2x revenue multiple. When you compare the numbers from 2018, the disconnect is stark. Traditional food manufacturers like Campbell's Soup had a price-sales ratio of 1.2, General Mills sat at 1.9, even the meat giant Tyson Foods traded at 0.7. Beyond Meat, meanwhile, was trading at 44. This wasn't just a difference in price, it was a difference in fundamentals. While Beyond Meat was growing rapidly, its gross margins, the profit made after the direct costs of producing the food, were lower than those of its peers. Campbell's Soup's gross margin was 33%, General Mills was 35%. Beyond Meat's was only 20%. Investors were betting that Beyond Meat would behave like a software company, where high margins and operating leverage, the ability to increase output without a proportional increase in cost, eventually lead to massive profitability. But Beyond Meat wasn't selling code. It was selling burgers. The problem was that Beyond Meat was not a technology company. It was a food manufacturing business. In the software world, companies often start by losing money to capture a market, knowing that once they hit a certain scale, they can trigger operating leverage. This is the ability to increase output without a proportional increase in cost, allowing a company to become wildly profitable almost overnight. But software companies can do this because they have incredibly high gross margins, often 70 to 80%. Gross margin is the percentage of total sales revenue that a company retains after incurring the direct costs associated with producing the goods it sells. Beyond Meat didn't have that luxury. At its IPO, the company had experienced losses in every single year of its operations since 2011. It lost $25 million in 2016, $30 million in 2017, and $29 million in 2018. Unlike software, there's very little you can do to fix basic unit economics. If you charge more to increase your margins, growth slows down or customers stop buying for Beyond Meat. The reality was stark. While it chased the valuation of a tech giant, it was burdened by the narrow margins of a food processor. The profitability level the investors were waiting for simply didn't exist. The business soon hit a wall of macroeconomic headwinds. COVID-driven inflationary pressures increased input costs in the production process and drove up distribution costs massively. In the world of food manufacturing, these are the basic expenses of making and moving a product. At the same time, consumers became more price-sensitive. As grocery bills skyrocketed, the higher-cost option of alternative meat became less appealing relative to traditional beef. This shifted the math for the average shopper. People were less willing to pay 50 to 80% premiums on products when their budgets were tightening. This created a dangerous feedback loop. As sales volumes plummeted, Beyond Meat was forced to operate its production lines below full capacity. In manufacturing, running a factory at low capacity increases the cost per unit because the fixed costs of the facility are spread across fewer burgers. To keep products on the shelves, the company had to discount its offerings in supermarkets, further eroding its margins. The decline was not a glitch but a trend. By 2022, the company began recording declining annual sales. According to data from market research firm Circana, sales of refrigerated plant-based meat alternatives saw double-digit year-over-year drops, falling to $279.3 million over the 12 months preceding October 2025. The decline was not just about the price tag, it was about the ingredients. While Beyond Meat pushed a narrative of sustainability, consumers began questioning if the products were actually healthy. To make plant-based proteins mimic the texture and taste of beef, the company had to heavily modify the core product. This led to the rise of the ultra-processed label, term used for foods that undergo multiple industrial processes and often contain additives not used in home cooking. Critics pointed out that while the patties were high in protein, they also contained seed oils and were high in saturated fats. This shift in perception coincided with the Make America Healthy Again movement, which emphasizes a return to whole, unprocessed foods. Financial analyst Danny Hewson noted that many people were choosing to seek out simple alternatives like beans and pulses instead of lab-engineered meats. Beyond Meat CEO Ethan Brown pushed back, claiming the decline was driven by misinformation and direction from traditional meat companies. In an attempt to pivot, the company began highlighting healthy elements in its recipes, such as avocado oil, yellow peas, and fava beans. But for many consumers, the damage was done. The image of the plant-based burger had shifted from a futuristic health innovation to a processed industrial product. Beyond Meat was not alone in its struggle. The company's fortunes mirrored a broader industry collapse. The U.S. plant-based meat market peaked in size in 2020 and has been declining ever since. For a time, the craze had fueled a massive investor appetite for alternatives. In 2019, data from Barclays forecast that the global fox meat market would generate $140 billion in annual sales over the next decade. But the reality proved far different. According to data from market research firm Circana, sales of refrigerated plant-based meat alternatives have seen double-digit year-over-year drops since 2022, falling to $279.3 million in the 12 months to October 2025. This retreat affected the entire competitive landscape. Rival Impossible Foods saw its internal valuation come down by at least half, based on 2023 reporting from Bloomberg. Even established players struggled. Kellogg had previously announced plans to split into 3 companies, with one of them being Morningstar Farms. However, by the time those details were formalized the following year, the company admitted that Morningstar was not valuable enough to stand alone. As the market shrank, the once dominant narrative of the industry shifted. The disappointment of Beyond Meat's stock became a reflection of the disappointment of the industry as a whole. The vision of a world where plant-based alternatives replaced traditional meat had collided with a consumer base that was increasingly skeptical, price-sensitive, and uninterested in the processed nature of the product. The disconnect between the company's vision and the consumer's wallet manifested as a physical crisis in the factories. As sales volumes plummeted, Beyond Meat was forced to operate its production lines below full capacity. In manufacturing, this is a critical failure. When a plant isn't running at full scale, the fixed costs of power, labor, and maintenance are spread across fewer units, which increases the cost of every single burger produced. This inefficiency bled into the retail experience. To move stagnant inventory off the shelves, the company was forced into aggressive discounting in supermarkets. This created a vicious cycle. Lower prices eroded the margins further, while the brand's prestige as a premium alternative vanished. In an attempt to find new revenue streams, the company diversified its product mix. They introduced a beef jerky alternative. However, this proved to be a strategic misstep. The jerky was a lower margin product, meaning it generated less profit per unit than their core offerings. Rather than saving the business, the move added more complexity to an already struggling operation. By this point, the operational reality was stark. The company was no longer scaling a revolution, it was managing a retreat. The goal had shifted from changing the global food system to simply trying to keep the factories running. The operational retreat had created a financial vacuum. While the company struggled to find a path back to growth, it was facing a looming deadline. In March 2027, $1 billion in convertible bonds come due. A convertible bond is a type of loan that can be converted into shares of stock if certain conditions are met. For Beyond Meat, this was a wall of debt they had no way to climb. The credit markets recognized the danger. Those bonds were trading at about 17 cents on the dollar. By 2024, the company was losing 45 cents from every dollar of sales on an operating basis. To avoid a near-term default on its credit, Beyond Meat launched a debt for equity swap. In this arrangement, a company asks its lenders to cancel some or all of the debt in exchange for ownership shares in the business. While the move bought the company time and put immediate bankruptcy concerns to rest, it came at a steep price. The swap hugely diluted the stock. Dilution occurs when a company issues new shares, reducing the percentage of ownership held by existing shareholders. With the equity value already down 96% from its IPO, the massive issuance of new shares further eroded the value for those who had stayed. The company had successfully avoided a total collapse for now, but it had effectively traded its debt for a fragmented ownership structure, leaving the original shareholders holding a dwindling piece of a struggling dream. Once a Wall Street darling worth roughly $14 billion, Beyond Meat is now a meme stock. The shares have slumped to 50 cents from their July 2019 peak of $39.71. Occasionally, the stock price spikes. In one period, it logged a near seven-fold increase over 4 sessions, but analysts say this is not a sign of recovering demand. Instead, it is a short squeeze. A short squeeze occurs when retail traders buy a stock in large volumes, forcing bearish investors who bet the price would fall to rush to buy shares to cover their positions. This creates a dead cat bounce, a temporary recovery in a continuing downward trend. For equity holders, the outlook is grim. Beyond Meat has recorded declining annual sales since 2022 and has never turned an annual profit. The company lost 45 cents from every dollar of sales on an operating basis, with the stock down 98% from early 2021 highs. Some financial models suggest the equity is worth zero. The company still faces a wall of debt, with $1 billion in convertible bonds due in March 2027. While the company has bought time through restructuring, the reality remains the business almost certainly won't be able to pay its debts. The dream of changing the world through a plant-based revolution has collided with the hard math of food manufacturing. For the original shareholders, the result is a total erosion of value.